He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She'll soon be quoted on the front page. Business Standard.
When it comes into effect, IFRS 17 will completely upend the insurance industry. It represents the biggest shakeup of insurance reporting standards for decades. Designed to increase financial transparency, it requires insurers to report in more detail on how insurance and reinsurance contracts affect their finances and risk. For all the IFRS 17 requirements, SAS provides a single comprehensive compliance platform for users of all disciplines, accountants, actuaries and IT alike. Its key features include a predefined comprehensive data model capable of receiving individual contracts or already grouped data, discounted or undiscounted cash flows, predefined data quality rules, predefined calculations of all components relevant for insurance and reinsurance contracts, both at initial recognition and during subsequent measurements, repeatable, customizable end-to-end processes that are fully transparent and auditable, predefined posting rules to convert calculation results into financial entries, an intuitive way to send subledger details to any general ledger, advanced financial reports with drill-down capabilities, and seamless integration with existing solutions such as accounting and actuarial systems. IFRS 17 implementation means making a long-term investment in a system that will be used for the next 10 to 15 years. SAS for IFRS 17 is designed to be able to manage both today's and tomorrow's insurance financial reporting requirements.
Good afternoon and welcome to the fourth session of Business Standard Presents De-Risking the Risk Business in association with SAS. After 3 insightful webinars on risk management in the banking sector over the last couple of weeks, we are moving the discussion to insurance today. starting with a keynote by former IRDAI member and followed by a panel discussion with risk management leaders in insurance and our knowledge partner, SAS. We have one more session to go in the series, which is also on insurance next Tuesday, 5th May at the same time. Thank you for being with us. You're watching this on the events website, bs-bfsiriskmanagement.com and Business Standard social media. If you're watching this on the events website, please type your questions for the panelists in the box given. We will be asking a few select ones towards the end of the discussion to the panelists. May I now request our consulting editor, Mr. Tamil Bandyopadhyay, to take over and introduce our keynote speaker.
Thank you, Manish, and very warm welcome. Very good afternoon and a very warm welcome to the Business Standard 5-event, 2-part series, De-risking the risk business. We had already closed the first part of 3 events on banking, and today we are kicking off the second part with on insurance, and today the first event of this. It's an honor and privilege to have Mr. Nilesh Sathe, former member of IRDA, Insurance Regulatory Authority, Development Authority of India, to be the keynote speaker to set the context. Apart from being with IRDA, Mr. Sathe have had 3 decades of experience with LIC, where he actually stepped down as a executive director. So we couldn't have a better person than set the context for this particular event. Over to you, Sathe sir.
Yes, thank you very much, Tamal, for elaborate introduction. Good evening, ladies and gentlemen. First of all, let me thank Business Standard for organizing such event on important topics concerning insurance companies year after year. I had the privilege of attending and participating such annual conferences of Business Standard more than twice in the past. This year, it's a virtual conference, and the topic is de-risking risk business, in which there will be a panel discussion today on a very important topic, IFRS 17. I compliment Business Standard for raising a very relevant topic today. Let me first talk about de-risking the risk business, and I will speak on IFRS 17 a little later. Insurance companies are in the business of taking risk. All over the world, insurance companies write policies that deal with specific risks, and in some cases, exotic risks as well. Obviously, one may conclude that insurance companies must be good at managing their own risks. But it may not always be so. Some insurance companies believe that insurance is only an underwriting game. If company underwrites right risk at right price, the other risks may take a backseat. Important risks in insurance business are, of course, underwriting risk, but along with that, reinsurance risk, credit risk, liquidity risk, reputation risk, operational risk, etc. All these risks are important and need to be identified and prioritized. The insurance companies which are listed on stock exchange now, they know that the identification of various risks is required to be mentioned in draft red herring prospectus and also in the red herring prospectus. Proper importance has to be given by all insurance companies in identification of risks, evaluation thereof, and understanding the importance of these risks. IRDA has issued guidelines to insurance companies to appoint chief risk officer who should report to risk committee. The CRO should ensure that the company has right risk framework, proper process of risk assessment, risk mitigation strategies are in place, and key risk indices are prepared to monitor risk regularly. India has not yet adopted risk-based capital or RBC model. Once it is done, companies which underwrite heavy risks like participating policies may have to provide more capital, while insurance companies doing more of ULIPs or term business may need less capital. Lines of businesses which have short tail like health may need less capital. It's high time that risk-based capital should be implemented by IRDAI, which may encourage more players to enter insurance business. Let me now talk about IFRS 17. Standards are notified under Section 133 of Companies Act 2013 by MCA after considering the recommendations of the National Financial Reporting Authority, NFRA. India has converged with International Financial Reporting Standards, IFRS, as a part of commitment to G20. India doesn't adopt IFRS as it is, but makes suitable changes and brings out Indian accounting standards, that is IND AS. Accounting standards currently applicable to insurance companies are IRDA Preparation of Financial Statement and Auditor's Report of Insurance Companies Regulations 2002 and the various circulars issued thereof. Regulations mandate insurance companies to follow the accounting standards notified under the Companies Act. There are 29 mandatory accounting standards, of which 25 are relevant to insurance sector. The following standards are applicable in a modified way. AS3, that is cash flow statements. AS17, segmental reporting, minimum segments which are prescribed under regulations. AS2, that is valuation of inventories. While AS13, that is accounting of investment. AS9, that is revenue recognition, are not applicable to insurance companies since they are governed by similar regulations framed by IRDAI. As I said earlier, based on the international commitment in G20, India is implementing converged standards of IFRS and not adopting them in toto. MCA notified a set of 39 IND AS on 16 February 2015. 33 IND AS are relevant for the insurance sector. Two important standards for insurance companies are IND AS 109, that is financial instruments, and IND AS 104, that is insurance contracts. As per IND AS rules, insurance companies shall apply the IND AS as notified by IRDAI. The relevant rule reads as under. The company's Indian Accounting Standard Rules 2015, notified on 30th March 2016, called as the company's Indian Accounting Standards Amendment Rules 2016. Rule 5, the banking companies and the insurance companies shall apply the IND AS as notified by the Reserve Bank of India and Insurance Regulatory Development Authority of India, that is IRDAI, respectively. Means for banking, it has to be notified by RBI, and for insurance companies by IRDAI. First attempt to implement IND AS, which is Converged Standard IFRS 17, was made by IRDAI when a working group on IND AS implementation was constituted in 2015. It submitted its report in 2016 with draft regulations on preparation of financial statements based on IND AS 104. that is equivalent of the interim standard, that is IFRS 4, and other applicable standards for insurance sector, including Ind AS 109. On 31st May 2017, in the 97th meeting of the authority, it was reviewed, that is the position of IFRS 17 implementation was reviewed. Insurance contracts were notified on 18th May 2017. It was thought that Ind AS implementation in insurance sector in India without equivalent standard of IFRS 17 would lead to asset will be valued on fair value or market value basis, while liabilities will continue to be valued as per the existing formula-based approach, which may lead to mismatch in the asset liability valuation and cause volatility in financial statements of the insurance companies. Avoidable efforts and costs due to quick transition twice, once for implementing the interim standard, namely Ind AS 104 equivalent to IFRS 4, and then change to IFRS 17 may also create a problem, as well as increasing costs. Implementation of Ind AS was hence deferred for a period of 2 years. As such, the standards were to be effective from financial year 2020-21. Accordingly, IRDAI commenced work on early adoption of new standards on insurance contracts in 2017. Working group on new standards on insurance contracts, that is equivalent to IFRS 17, was constituted on 21st August 2017. The working group worked closely with ICAI to issue exposure draft of the equivalent standard in India titled as Ind AS 117 on 12th February 2018. Working group submitted its report with draft regulations on preparation of financial statements considering IFRS 17 on 31st October 2018. In the meanwhile, considering the concerns around accounting treatments and operational complexity and implementation challenges raised by various stakeholders, the IASB had taken a considered view to amend IFRS 17. Meantime, the effective date of implementation of standard was deferred by 1 more year, that is from 1st January 2022. IASB has published the exposure draft of the proposed amendment to IFRS 17 in June 2019. On 25th June 2020, IASB issued amendments to IFRS 17, and effective date of implementation was deferred further by 1 more year, that is 1st January 2023. The following are the broad changes carried out in IFRS 17. Allocation of acquisition costs to expected contract renewals, where the acquisition cost is more than premium. Such acquisitions cost can be amortized over a period of contract. Attribution of profit to service related to investment activities. This will be more relevant for PAR policies, that is participating policies. It provides an option to the insurers to apply similar method for valuation of assets and liabilities of PAR policies. Extension of the risk mitigation option to permit a company to use the risk mitigation option when the company uses reinsurance contracts held to mitigate financial risks of insurance contracts with direct participation features. Reduced accounting mismatch for reinsurers. Simplified balance sheet presentation requires a company to present insurance contracts assets and insurance contract liabilities on the balance sheet using portfolios of insurance contracts rather than groups of insurance contracts. In the Indian context, equivalent standard of IFRS 17 is not yet notified. Only after the standard is notified, IRDA will be in a position to notify the regulations on preparation of Ind AS compliant financial statements. Insurers will have to be given clear timelines, at least maybe 2 or 3 years after the notification of regulations before the standards can be implemented in India. IRDA, via its circular dated 21st January 2021, has specified that implementation of Ind AS 109 and IFRS 17 equivalent in India simultaneously, along with other applicable Ind AS, revisit existing regulations on preparedness, on preparation of financial statements, direct the insurers to discontinue submission of pro forma Ind AS financial statements being filed effective from quarter ending 31st December 2016. Otherwise, insurance companies were filing these quarterly statements, which has been discontinued now. To decide on the date of implementation of all applicable Ind AS after finalization of IFRS 17 by IASB. How IFRS 17 is different from IFRS 4? It will be worth mentioning that IFRS 17 sets out the requirements that a company should apply in reporting information about insurance contracts it issues and reinsurance contract it holds. IFRS 17 requires a company that issues insurance contracts to report them on balance sheet as the total of the fulfillment cash flows, the current estimates of amounts that the company expects to collect from premiums and payout for claims, benefits, and expenses, including an adjustment for the timing and risk of those amounts, and the contractual service margin, the expected profit for providing insurance coverage. The expected profit for providing insurance coverage is recognized in profit and loss over time as the insurance coverage is provided. IFRS 17 requires the company to distinguish between groups of contracts expected to be profit-making and groups of contracts expected to be loss-making. Any expected loss arising from loss-making or onerous contracts are accounted for in profit and loss as soon as the company determines that losses are expected. IFRS 17 requires the company to update the fulfillment of cash flows at each reporting date using current estimates of the amount, timing, and uncertainty of cash flows and discount rates. IFRS 17 also requires disclosures to enable users of financial statements to understand the amounts recognized in the company's balance sheet and statement of comprehensive income, and to assess the risks the company faces from issuing insurance contracts. A question may come, why IFRS 17 when there was already IFRS 4? The reason is IFRS 4 does not address how to measure insurance contracts. Insurers currently use a wide range of insurance accounting practices for reporting on a key aspect of their business. Differences in accounting treatment across jurisdictions and products make it difficult for investors and analysts to understand and compare insurers' results. Insurance contracts often cover difficult to measure long-term and complex risks. Insurance contracts are not typically traded in market and may include a significant deposit component, posing further measurement challenge. Some existing insurance accounting practices fail to reflect adequately the true underlying financial position or performance arising from these insurance contracts. IFRS 17 will make insurers' financial reports more useful and more transparent, and insurance accounting practices consistent across all jurisdictions. The date of implementation is yet to be notified by the authority. However, in the given circumstances, it would be more appropriate for the authority to implement converged standard to IFRS 17 along with Ind AS 109, that is valuation of investments. Further, insurance sector should only be mandated to go for Ind AS once it is implemented in banking sector. So it looks like Ind AS in insurance sector will not be implemented before 2025. It will give time for insurance companies to develop skill sets and get ready for the implementation. This is all from my side on de-risking risk and IFRS 17. I look forward for a wonderful panel discussion by eminent panelists on the IFRS 17. Once again, I thank Business Standard and Tamal for giving me this opportunity to deliver a keynote address. Thank you very much.
Thank you, Satya Saab. Actually, the pleasure is ours, and we must thank you for taking your time out. And you are so clinical and so methodical in your approach, as always. And actually, you have done much of my work, so I would not need to spend much time explaining things. But before that, ladies and gentlemen, welcome to the first of the two-part series on de-risking the risk business as far as the insurance is concerned. Business Standard event, IFRS 17 from compliance to business transformation. And trust you me, we have a really star-studded panel. Let me introduce the panel first. For the first time, we have a gender diversity. Unfortunately, we did not have any woman, any lady on the panel in the past 3 panels on banking, but we could break the ice and got it. So let me introduce Asha Murli. She's the EVP and appointed actuary, ICICI Prudential Life. Then we have Neeraj Shah, CFO, HDFC Life. We have Avdesh Gupta, again appointed actuary or the head of actuary, whatever you call, Bajaj Alliance. We have Suprajit Mukhopadhyay, Executive Director, Edelweiss Tokyo Life Insurance. We have Mandeep Mehta, head of, is a deputy CFO, and more importantly, is or equally important, head of data science at data security at Max Life. And finally, Joshua Thing, he's a senior solution advisor, risk research and quantitative solutions, SAS. He's based in Singapore. So good evening, Joshua. And he is currently handling some many markets in Asia, APEC, to be precise, about the implementation of IFRS. Joshua is here for sort of knowledge partner. From him, we will understand what happens to the other side. I mean, the other countries, the developed markets, how they are preparing themselves. So we have 6 panelists. We have about an hour's time, and then questions already started coming in. One of my colleagues is collating all the questions, so we'll take a few questions also. So here are the rules of the game. I'll just introduce the subject, which I don't need to do much, and then we'll have a quick few rounds, your views on this. As Mrs. Hathi explained very well, the D-Day is January 1, 2013, but he hinted that India may take a while, a little longer than other countries. It will of course apply to all insurance, and which he did not mention. I'm adding insurance and reinsurance contracts. Now, what does it mean? Again, very simple. Under this model, in all insurance contracts, liabilities will be calculated as the present value of future insurance cash flows, and all the insurers will have to provide for the risk of that. And if the present value of future cash flows translates into a gain at the time of the contract is issued, the model requires a contractual service margin to offset the first day gain. So the contractual service margin would amortize over the life of the entire life of the contract. And finally, there would also be a new income statement presented to the presentation for insurance contracts, including a revised definition of revenue and additional disclosure requirements. I just want to quote the international body which actually formulated this particular norm. The chairman of this, Hans Hoover, who it's very difficult to pronounce his name. He's a Dutch politician. Let him call Hans. He says, use of a current discount rate is the key benefit of the new standard. He also says, if the industry does not do this, the devastating impact of the current low interest rate environment on long-term obligation is not as visible in the insurance industry as it is in the defined benefits pension scheme of many, many companies. So in sum, now what does it mean? It all actually boils down to very complex data requirement, data storage and calculation. And of course, much more disclosure requirements. Now, business gains will be quicker, faster decision-making, agility, and responsiveness to opportunities and threats. Mr. Sathe already explained how the banks also, Indian banks also need to do this. And he did mention that probably bank and insurance companies will go together. This is an ex-regulator speaking in some sense. So let's get into the rounds of questions. First, Asha, you have the advantage over others. As I said, the gender diversity and the first lady on our panel. So the honor is yours. Tell us, it's one of the biggest regulatory challenges for the Indian insurance industry, and the industry is now over 2 decades old. I'm talking about the private Indian industry, and unfortunately, we don't have anybody from the state-run sector. So, how do you think it will impact the future reporting and analysis?
Thanks,
Asha,
Tamal,
what
for
will you?
having me. Yeah, thanks, Tamal, for having me. Like you said, this is a very complicated standard. There are a lot of nuances to the standard. Right now also, I think, see, fundamentally the insurance industry is all about collecting premiums and making payouts and making sure that these payouts happen, that there is ability to make these payouts, and at the same time, the contracts being profitable. So fundamentally, I think it's still the business remains the same. It's about making sure that you charge the right premium, have sufficient risk measurement practices in place so that whatever you expected to happen happens the same way. It's a long-term business, so of course the risk management that you need to do is also is a bit complicated. There is a lot more monitoring which needs to be done. So fundamentally, the business still remains the same. It is just that you will get much more insights from the business. So it is not that we are not actually getting those insights now. I mean, there is a set of reporting which we do, and we also do much more supplementary. We also look for supplementary information, and we also give the supplementary. We publish also the supplementary information so that investors understand what the risks and how the business is performing. It is just that the standard kind of puts everything together in place so that there is much more granular information which is available readily for the business to act on. And to that extent, yes, I think it's easier to be more reactive. There is more information which is available, and what gets monitored eventually will also drive outcomes in that way. So I think that's what the standard would do.
Thanks, Asha. These are all preliminary remarks. We will cut the cake as we go forward. So let's the same questions to Neeraj from HDFC Life. You tell us that how would it impact the future reporting and analysis? Neeraj.
Thanks, Tamal. Thanks, Business Standard, for organizing, and thank you, Mr. Sathe, for the wonderful address.
And Neeraj, Mr. Sathe is around. He's listening to you, and he has agreed to take a few questions. Neeraj, please.
Great. Tamal, the way I look at it is that you mentioned that some of us have embarked on the journey for higher disclosures, having got listed a few years ago. And we also obviously closely tracking how this whole standard implementation is progressing in other parts of the world. It's not been easy. It's not been easy for multiple reasons. This journey started, I don't know, 12, 15 years ago, and we are still thinking about, how to get it done. So that basically tells you that there are things which remain to be resolved locally based on the regulations that prevail in every jurisdiction. Also, from an analyst or investor perspective, like Asha mentioned, there is enough information out there for someone to make an assessment within a particular framework. That framework today does capture a lot of nuances around how risk is measured and how the business is actually shaping up from a medium to long-term perspective as well. So, I would just as a first thought say that IFRS or any reporting standard is a means to an end, not an end in itself. It's not a panacea. We should not expect that overnight we'll all be enlightened with information which will help us all take great decisions, either as a business or as an investor sitting outside. So that's basically my first take on this, and absolutely, we'll do whatever needs to get done to kind of get this off the ground in the right way. But there are a lot of things still open-ended.
Thanks. Thanks, Neeraj. These are all preliminary. This is the first take. So what Asha spoke about, the granularity of data that the insurance companies would look for. Neeraj said that, look, some of them are already listed. So they are aware of this and they are already doing it. So the same question, your first take, Avdesh from Bajaj Allianz.
Yes, thank you, Tamal. So my view is also similar to what Asha and Neeraj just said. I think the important change that is coming is the way currently we have been valuing our business in the Indian GAAP or IFRS 4 basis is more like a book value basis. We do make certain long-term assumptions about the future. Importantly, on the interest rate side as well, we do take some subjectivities in our interest rate assumptions as well. I think that part is going to change under IFRS 17, where the view will be more like a market consistent view, where everything that you're valuing on our contracts will be on what is prevailing in the market right now. So that I feel is a big change, where the valuation of your company is going to reflect what is prevailing in the market right now, rather than making certain long-term assumptions. Secondly, I think the view will also be changing with respect to how, because the profitable contracts are looked at differently from the non-profitable contracts, which is something Mr. Nilesh also alluded to in his keynote address, called onerous and non-onerous contracts. So I think that will also bring out a lot more details into how the companies are managing their profitable source of businesses versus the non-profitable source of businesses. So I think it's a more like a principle-driven standard. It is not a prescribed standards. A lot of accounting policy decisions will have to be made by the companies. A lot more auditing will be required. A lot more disclosures will be required. And there will be still, even though the standard is quite detailed in nature, there will still subjectivities in the nature on which companies will have to take certain decisions on their accounting policies or on the approaches that they will have to follow.
Thank you. That's the beauty of all the panel discussions. Like each of you bring in a new dimension. Thanks, Avdesh. I mean, essentially what you spoke about, what the banking parlance they call mark to market for all your investments, right? If it's a gain, you are not allowed to take directly to your balance sheet. That's what also the new norm is talking about that, but you have to provide for it anyway, for any loss. So Subrajit Mukhopadhyay, Edelweiss, give your first take.
Yeah, I think as Asa pointed out very rightly, the underlying is not changing. I think the business core business principles remains the same.
Your voice is, Subrajit, can you talk a bit louder?
Yeah, am I audible?
Yeah, you're audible, but voice is little low. Just talk a bit louder.
Okay, sure. As Asha pointed out, that I think the underlying remains the same. And the core underlying of the business is never going to change. It's the same as usual. However, this is a typical long-term business. We have a liability spanning up to 20, 30, 40 years. How do we value that underlying for such a long period of time? I think valuation of the underlying is the trick. And that's where we use the book value approach, market value approach, and some changes around that. But the IFRS 17 is primarily takes into consideration the financial statement. But however, for an insurance company, in addition to the financial statements, you also need to look at the capital arrangements as well. So unless the IFRS 17 is also reflected as changes with the capital RBC that Mr. Nilesh Shate is also mentioning, it will not be a full complete transition, because then you will have a different capital regime vis-a-vis a different financial statement that will come across. That is point number one. I think these two has to go hand in hand, and that's extremely crucial from the industry point of view. Point number two is that at the end of the day, how you value also means how you report and what your executive remuneration to shareholder dividend and so on and so forth. So many of the reporting will determine some of this outcome. Some of time will lead to some of your strategic choices as well. So what kind of a product mix you would like to encourage, what kind of a loss you would like to take, what kind of a cross subsidy your current mechanism will undergo changes, what kind of a risk management approaches, including reinsurance, you will likely to undertake, what kind of a long-term asset liability management, which is a critical, important, most critical for the life insurance business to adopt. Many of these things will undergo changes and will put us a lot of different choices to take on. So it's extremely nuanced, extremely complicated, extremely strategic, although not changing the underlying as such, but in terms of overall presentation. Yeah, that's my initial take. I'll explain later.
Thanks, Subrajit. So extremely complicated and extremely strategic. We'll get back to you, Subrajit. Meanwhile, if you can just address your voice, you are audible but little low. We need to ramp it up, your volume.
Sure.
Yeah, Mandeep, your turn now. Mandeep, you are not only the deputy CFO, but you are also head of the data security. So you are coming from you have a much wider sense of what's going to happen. Tell us. Mandeep is from Max Life. Yeah. Unmute yourself. Mandeep, you're on mute.
Yeah. Can you hear me?
Yeah.
Thank you, Tamal. Thank you, Business Standard. And thank you, Sathe sir, for setting the context so rightly. Tamal, first of all, it's not data security. I look into reporting and data science. So,
data science. Sorry.
Yeah, I was almost about to,
pick up. My bad. Sorry.
No. So the advantage of speaking in the end is that, everything has been said and you have to only reiterate few points. But I'll take slightly different take. First of all, this is a complex reporting. This insurance accounting is not being discussed for IFRS 4, phase 1, phase 2 time only. Even before that, the confusion was that, whether we should use a construction accounting kind of method for a long-term contract accounting or not, and so on. So as Neeraj said, I mean, this is far from over. These changes will keep on happening. This will become more complex and complex. Why it is needed is that there is a need that investors should be able to compare companies across spectrum, across geography, across businesses. And that's why everybody should adopt a common business language. And that's where the whole thesis of IFRS 4 and 17 came into being. But unfortunately, these standards are principle-based standards, right? So these are free to be interpreted by the company who is implementing it. So whether one particular parameter is comparable to another or not will depend upon the disclosure in the accounting policy as to what choices they have exercised and how they have implemented it. If that is not done, these data points are not that comparable. Another thing which is happening is that, as Asha mentioned, and Neeraj also supported, is that we are already doing that reporting. Currently, the statutory reporting is looked at by regulator only. Companies Act, guys for dividend declaration, etc. Tax guys to tax the company, that's all. But for all practical purposes, decision making, investing by investor, people look at the other parameters like embedded value, which is already being published. What will happen now is that some component of these parameters will go into your financial statement, which means the things which were not getting audited so far, not certified by an auditor on a particular standard, will now get audited and certified. Right? That's the biggest advantage, I would say. Otherwise, EV, etc., are unofficial codes. This become official. Okay. This changes how companies are seen. in terms of, there's a very important principle of accounting is that the information should be relevant and should be understandable by a user of financial statement. My take is this is so complex. The user of financial statement are not going to understand a financial statement unless they are specially trained, which means whole lot of effort need to go into training the investor as well, who can make use of these statements. This will require a greater degree of automation, collaboration, and a good quality data governance program, because now this will be get certified, audited, etc. This is not more a question of auditor to look into whether the data is reconciling, actuarial data is reconciling. Now they have to also see how the data is being generated, what are the hands off, and whether the authenticity of the data is there or not. Last but not the least, the changes in decision making is very relevant point. Now you will not see the large top line. If let's say the investment component is taken out and taken into balance sheet, the top line will get reduced. So which means the ranking, etc., comparison of the company will come down to looking at what margins they are generating. Right. So those kind of decisions in day-to-day life will come into picture. Also, the knowledge of decision-making parameter, how insurance company make finance, what these parameter means will get democratized at a middle management level. As of now, the few folks in finance, few folks in actuaries understand it, maybe in product, and then they drive decision in the organization. Now this information will go down in the middle level so that they can also contribute, you can run the show. So this is, I think, is a cultural change actually. It's not just a reporting change.
Thanks, Mandeep. Very, very valuable input. It's a cultural change, not the reporting change alone. It seems like everybody discussed something. So whatever Asha says, and I thought you could guess that being a lady, she will be the first speaker. So everybody takes from there that Asha said that, and okay. So it's good to hear that she has set the tone. But Mandeep, you said two very critical things. One, you are saying that already you have been doing some part of it, or large part of it. You just need to formalize it. But most importantly, you said the investors need to be educated how to read the numbers. I mean, I have never heard this before, because typically the people say that the organizations need to be reskilled. You spoke about how the investors need to be reskilled to understand the balance sheet. Yeah, Mandeep, you want to add?
Not only investor, I think the board of director also need to be trained.
Okay. It's very nice. Very nice. I mean, very candid chat. That's what, it's a little technical subject. So that's the only way to make it interesting and interactive. That, yeah, it's not typically we do speak about only the people who need to be educated, need to be reskilled. Mandeep is saying even the board and the investor, they need to be reskilled. Last but not the least, Joshua, patiently waiting from Singapore. You have been hand-holding many companies in the APEC, Asia Pacific market. So tell us your take on the entire thing about this, on the same way, on how it is going to impact future reporting and analysis. Mm-hmm. And do you agree with Mandeep says?
Yes, totally. Thank you, Tamal. So what we see in basically Asia Pacific, it's that, as what everybody mentioned, the way of managing a business doesn't change. It remains the same. Essentially, for insurance company, you're collecting premiums and you're trying to make sure that, you pay out lesser. So that's one way you can make money. And of course, the second way that you can make money is from your investments. So right now in basically all insurance companies, right, these two ways of profit are being mixed together. So I think one of the key challenges and one of the key insights that we got from IFRS 17 implementation in the region, it's that now it forces you to separate them. So you clearly have one line, which is insurance service margin or insurance service performance. And then you have a separate line, which is, investment service performance. And this has created quite a bit of problems and also opportunities in Asia in some clients. So what we see is that, there are certain players that are going into the market and they are trying to make money more from the investment side of things rather than on the insurance side of things. So take, for example, you have an investment contract. You can invest and you can buy maybe at 3%. Okay, and then you're giving to basically the policy holders maybe 2%. but then at the same time, your valuation rate, it's lower than 2%. So what we see is that for these kind of contracts, it's very common to see them as onerous. And when they're onerous, it comes out on your balance sheet and it looks very ugly. And back to Mandeep's point, it's that it's not that we're losing money on these contracts. It's we need to educate people that there are certain contracts where the profit for the company comes from the investment side, and there are certain contracts where the profit comes from the insurance side of things. So it's a whole re-education to investors, to policyholders all over again. And it gives people more insight to the business, like where exactly is my source of profit coming from. And then in terms of impact from analysis, IFRS 17 requires us, to pull together accounting data and pull together actuarial data at a very granular level. Last time we always did it at a company level. Right now we need to do it at, ICG level, or some people go even lower or more granular than that. And that basically creates opportunities. However, at the same time, it is expensive because it requires, a rejigging of your data warehouse and everything. So a lot of people are taking this opportunity to, just jumpstart a separate project for actuarial transformation, to improve the KPI reporting processes. So this is what we're seeing right now in a couple of markets in Asia.
Okay, thanks, Joshua. So let's get from macro to micro. If I'm not seeking any confidential information, you don't need to share with us if there is something confidential which you can't. But can each of you tell us, like, how are you preparing yourself? Like Joshua said that many of the companies have seen that they are actually seeing it as a project and approaching it by launching separate projects, etc. Is this the way to go ahead? Are you looking for new people, new talent pool, or how are you doing it? So let's ask Avdesh first. Avdesh?
Yes, hi. So I think the first stage for any company would be to draw out an implementation roadmap, like a project charter, right? And actually, once you start drawing out the project charter, you will understand the enormity of the exercise. And that's where it will start hitting you that the exercise itself leading up to the implementation actually quite massive. I think, and once you start doing that, I think that then you would start to do some preliminary some gap assessment. So which would include understanding of the standard, what does it require, what are the wording of the standard, how does it require you to change certain things, understanding the data requirements, and you have to do a high level impact analysis as well. So how different lines of businesses are going to change. And as I initially mentioned, along with that, I think the important part where insurer companies would probably need to spend a lot of time is around the accounting policy decisions, because there is a lot of things, judgments where are required in the standard where company needs to decide on the approach that they want to follow on certain things. Similarly, on the for example, the accounting, the discount rate approach, you could think about how you calculate the risk adjustment for the non-financial risk. The way you want the granularity with which you want to measure your contracts, profitable, non-profitable. So a lot of subjectivity, a lot of accounting policy decisions have to be taken. I think that is where a great deal of work will be required. And secondly, once you've thought about all of that, then you move to a transition date where all the in-force book will need to move to a transition date valuation, where you would have to assume that if IFRS 17 was there since the beginning, what would the contract look like now? That itself is a very enormous exercise. And then you start thinking about the implementation and the drawing out your financial statements based on these. So I think currently there are companies at various stages. So I think we have been started doing out at least the initial gap analysis, drawing out the project charter map, and that has given us some bit of insights in terms of what does it entail for us to take it to the implementation stage. There are constraints with respect to the system side, the data side, the enormity of the data changes it would bring to even the resources are also resource constraints are also there apart from the financial impact of getting this implemented.
Thanks, Adesh. Thanks. We'll get into some of the pieces at a micro level later. So let's ask Neeraj. Tell us what's the kind of preparedness you are seeing within your organization and around.
So Tamal, for us, like Mr. Sate mentioned, in that phase of 2017 to 19, there was a lot of work done, and there was a working group which was constituted, and each of the companies did what they had to do to try and understand how they will get ready for it. So from our perspective, impact analysis in terms of basically three aspects. One is in terms of are we going to take business decisions differently? Second is in terms of are we going to communicate differently to our board and to our investors? And third, are we resourced appropriately in terms of are all the relevant people in the company who are going to be working on this together, primarily the IT team before anybody else, then the finance and the actuarial teams. These are the three core teams who are going to be actually taking this forward. Are they equipped in terms of the systems as well as in terms of the way the data flows through the entire system? What is the kind of readiness for that? And what kind of implementation partner we will need for project management? Is it going to be an accounting firm? Is it going to be an actuarial firm? Is it going to be a combination of that along with an IT firm? So a lot of those discussions had happened at that point in time. And of course, we've been in touch with the regulator in terms of how they are thinking about it, seeking clarity on some of the aspects that are required in terms of are we going to move to risk-based capital, because that's something that needs to move along with this, if not precede this. Second is also in terms of what kind of transition are we going to do in terms of, is it going to be completely looking at the back book, or is it going to be prospective, or is it going to be somewhere in the middle? That also becomes extremely important. Third is also what Mr. Sate touched upon, is an integral part of a lot of our businesses is the participating book. And how is that going to be treated? So for some of those, I think there are some answers, but more questions at this point in time. So if you ask us in terms of where we are at this point in time, I think we probably, from the time we kind of, get direction that this is it and this needs to kind of come in, like Mr. Sate said in his keynote address, it's a 2 to 3 year implementation roadmap at the very least. And then you do a dry run and then you kind of get ready. So the way we are thinking about it right now is that when there is enough clarity, we would then invest more in terms of resources. A lot of thinking has happened. Impact analysis directionally has happened in terms of, we discussed in the earlier round. Are we going to do anything differently on a business side? Most likely not. There are these core opportunities and business segments that are out there, whether it is in terms of addressing the protection gap, or getting to a pension society, or addressing the long-term savings needs of people. That's not going to change whatever accounting or actuarial standards you use. So that doesn't change. So from a business decisioning perspective, we don't see too much changing. Of course, a lot of these things that we discussed have to be given enough time and investment, and we will do it when we are kind of seeing that line of sight in terms of how close are we moving, and also in terms of, is it moving in the banking side and then on the insurance side. So a lot of these things actually come into play.
Thanks, Neeraj. So at this point of time, there are more questions than answers. That's what you summed up really well. So let's hear Suprajit. Your audio is fine now. So tell us about invoices.
Is my audio better now?
Yes.
Yeah. Yeah. Thank you. I think this is a very interesting exercise, and I think it's a huge project management exercise for sure. And we need to ensure that all the project management pieces are inbuilt here, outlining the entire project PMOPs and getting this through done. But more than the project management, I found it extremely interesting that it will be a lot of iterative exercise. So as we go along the project, you will learn something, go back to that and change it. I think it gives us a lot of agility in the entire journey. A lot of questions will be answered while you embark on the journey. So it's not a very fixed definition that you will set out at the beginning and have all the answers ready at the beginning. So during the journey, and sometimes staying on the problem for a little bit more time, as Neeraj also mentioned, the thinking part is extremely critical in this place. And we are also on the same thinking part, understanding the gap, understanding the impacts, and also the choices that you have to make, both in terms of accounting policy and the decisions, as well as in some cases strategy choices. As I said, the cross subsidies are important strategy choices that one needs to make, and so on and so forth. So I expect the project management piece and the thinking piece to go hand in hand and come to a convergence over a period of time. staying on the problem is a good exercise to always have. And I think in this case, I encourage people to stay on the problem slightly for a longish period of time rather than jumping into solutions, because the risk of this is that it can be too early and you have to redo many of the things at a later stage. So, and talk to the peers, talk to the consultant, talk to the other industry players, talk to involved in forums like that, so that we can get a more clarity as we discuss and more nuances we get to know. So yes, from us, our side also, we have started the gap analysis and the impact analysis both. But while we engage with the implementation partners as well as the software vendors, we also like to stay on the problem a little bit more to understand some of the nuances to get a better clarity over a period of time. So this implementation plans requires a significant involvement in the thinking process as well, unlike many other projects that we have seen.
Thanks. So what Neeraj said, that at this point of time, there are more questions than answers. Subhajit said it in a different language, but meaning is the same. Situation is evolving. So yeah, let's hear now Mandeep Mehta. Mandeep, come on, what's your take? And I corrected myself. Let me correct myself once again and apologize. You're apart from being Deputy CFO, you're the head of data science, not data security. My bad. Mandeep.
Okay, I'll stick to your question of where we are in terms of implementation and
your preparedness.
Preparedness. So we are already, all insurance companies were already preparing IFRS 4 kind of statement up to few quarters back, as Mr. Sathe also mentioned. We are also submitting audited Ind AS statement for our holding company for consolidation. So audit nuances and providing some disclosure, etc., which is already in place. We have already done prelim assessment of product classification, etc., and some of the issues on par, etc. Those has been already dealt with respect to IFRS 17, not IFRS 4. Also evaluated certain system. We have a short list in terms of who is providing what, but we have stopped any big bang investment right now, right? Because as Nisha said, RBC is a very, very critical element. GST, tax, etc. All those considerations.
I think Mandeep
need to evolve at the same time. Phases of
please carry on. Yeah, there are some problems.
What we have done.
Yeah.
Okay. What we have done in initial stages of the project was we trained our people. At one point of time, I had 11 IFRS certified accountants in the team. I think by far the biggest concentration of such certified accounting team. But over a period of time, because this was delayed, people have lost interest and probably moved away. But this is I think the thing to be done is that you need to train people en masse, because when there are more problems, more questions than solutions, then you need probably more heads. You don't know from where the solution will come, and you have to train in any case. So that's where we focused, and we already launched a program where anybody can come, and not only finance, anybody can come from any function and say that I want to have a IFRS certification. We'll fund it. Okay, so that kind of program is already in place. I was saying the reporting tool, etc. We have hold on. This requires a little bit more work, and as and when opportunity comes, our endeavor, we are committed to support industry, regulator, tax authorities, whosoever need our help to help deal with this particular situation.
Okay, thanks, Mandeep. So let's hear Asha. Give us a sense of the preparedness of ICSA crew on that, to the extent possible.
I know panelists said this is a very complicated standard. So we started preparing when the initial standard was notified in 2017. We started preparing quite a bit. There's a lot of thinking which is involved in the standard, and you also have to form opinions as to what could be your possible, because it's like it was mentioned, it's a principles-based standard. Therefore, you have to start forming opinions of the kind of approach you would take. Of course, you would also have to see the impact on the numbers. So we had started on this journey. Of course, we slowed down a little bit because of the uncertainty. But we have another constraint in that we have to provide results for our JV partner for their consolidation. So we will go ahead. So we are now looking at what could be the possible solutions, and how do we go ahead and implement it. Of course, it is a very complicated journey. In that you might have to keep taking decisions, revisit those decisions, see the impact on the impact which will be there on your financial metrics. Maybe revisit some of the decisions, but that's where we are. Most of the thinking part is what we have completed. We are looking to see how to actually physically implement it.
Okay, thanks, Asha. So, if I summarize, all of you have been saying it's a very complex journey. It's there at this point of time. There are more questions than answers, and things are evolving. And another part is this also. It involves a lot of investment. So let's hear Joshua. Joshua, can you tell us, sitting in Singapore, looking at the Indian insurance industry, what would be the key piece of technology? I'm sure, I mean, for banking, we talk about AI and ML, artificial intelligence and machine learning. We talk about cloud, etc. So for this migration into this new setup, it's January 2023, but it looks like Indian entities would be taking a little more time. Of course, it will be permitted by the regulator. But tell us that if we look at the technology part, what's the key technological change that they need to embrace?
Yeah, thank you, Tamal. So in terms of key technology change that we see right now, it's, we probably need a unified platform, which will basically take up three pieces. So we see three key pieces. One, it's from the data management side. So you need a tool that is able to touch base with all of your existing source systems, hold the data and unify them in one place. And then you need a very flexible calculation solution. So I think, as shared by the other panelists, now, because there's so many questions, there's so many uncertainties, we are looking at the impact. So you will probably iterate quite a couple of times as you go through this project. And as you iterate, you want the flexibility to be able to, configure your own formulas, to do something that's different, study the impact, and to have these options open to you, and to do it with a low cost. So that is one of the key, one of the key things that a solution needs to provide. And then, of course, you also need to pump it into an accounting system, which will generate the calculations and the ledgers for you. And overall, everything needs to be synced up. You need reconciliation points. When you have different systems talking to each other, each of these hands-off points, you will need something that says that, nothing is dropped, the data is correct. And if there are any manual adjustments or manual intervention, are they properly logged? Because, other systems, other calculations, as previously mentioned, EV, it's not really that audited. But now we're talking about financial statements. Financial statements has a higher bar to cross. And therefore now the controls around this whole thing, it's important. And that's why we're seeing more and more interest in, let's say, a unified system like SaaS. And that's one key technology, which I think that at least in this side of the world, we see people investing in.
Okay, thanks, Joshua. So we have sort of finished a little more than half of what we wanted. So let me combine what I wanted to have. We'll try to have two more rounds. And Neeraj, I understand you have an investors call. You need to leave early. So I'll start with you at this point of time. And more or less the same questions for you. It's a few questions bundled together. One is this. We heard one of you, Mandeep, talking about it's the investors need to learn how to read balance sheets. Even the board of directors, they need to learn the new balance sheet, etc. So one is this, can you tell us, I mean, each of you, I'm starting with Neeraj, can you tell us that, do you need a new skill set for the employees for this transformation? I mean, how you overlap or you straight away transform, that's only a technical part. But to change this thing, to change your entire, one of you spoke about it's not into complex data, it's the entire cultural change. And we have seen that some of the banks which are before COVID, which were actually pushing digitalization persistently on their own to have an edge over others, they also needed this cultural change and the new skill set. So can you tell us, each of you, there are two parts I want to know, organizationally, apart from technology and investment and data science, etc. What kind of cultural change you need? How do you reskill your people? Or do you need to bring in the new skilled people? That's one part of it. And second part of it, which you have not discussed, can you tell us, is there anything for me as a consumer, as a customer, like your offerings? Will it be, once you have this, your balance sheet will have complete segregation between your insurance products and your investments, and you look very different. So can the Indian consumers can expect some kind of not a revolution, but evolution in the product offering, newer products? Neeraj, we'll start with you. Take your time, a few minutes. Don't have to be really very short. Tell us these two points.
Thanks, Tamal. To your first point in terms of cultural shift and readiness, you're right. The example that you mentioned on the digital side, that's a great example. You can never predict or be prepared for a pandemic, but you can always try and do things which will help you when the times are unpredictable. So the example that you gave of digital is something that definitely helped a large part of the industry, certainly us, to try and ensure that there is a continuity in business. There is customer servicing which is not impacted, and then new business as well. The distribution as well as customers are equipped to handle that whole process. So that big shift is something that we've seen in the recent times, and that requires years of investments in the past. So it doesn't again happen overnight. So that investment journey has been there for a long time. Similarly, in terms of this example around IFRS, the key aspect we believe culturally is collaboration between teams. And this again is something that is a journey. You can never be 100% there. But are you doing enough is a question that we do ask ourselves in the business. And collaboration among these three teams that are relevant to this subject, IT, Actuarial, and the finance teams, that's something that we've been working on for quite some time. And that's where some of the stuff around how data is used, how data is recorded, and how it is used to make business decisions is something that we have done a lot of work on. So culturally, this is one very key aspect of being ready to implement a fairly comprehensive project like this. And that's something that I think we've covered a fair bit of ground. And we can certainly do more, but that's something which we believe is going to be the most important in terms of sharing of knowledge and asking questions without feeling that you're getting judged, that okay, I'm an accountant, I don't understand this, how is someone going to explain that? If I'm an actuary, I don't understand a simple aspect of accounting, how am I going to be judged around that? I'm an IT expert, but I don't know how this is going to flow from A to B. How am I going to be judged? So these are things that we're trying to address, and it's going to be key to actually make this transformation possible. To your second point around so skilling, technical skilling, and all of the bits, of course, will happen with time. But clearly, it is more in terms of if the collaboration and the knowledge sharing is there in the existing set of team, you can always get some sort of help from outside to try and get the bandwidth. Which may be a variable capacity to some extent. And of course, the skilling will anyway, over the years, it has started happening. So we listed 3 years back, but the entire economic framework of reporting is something that started 8 to 9 years back. And that required a lot of skilling in any case across these teams. And that journey needs to continue and maybe, move in a slightly different direction. If you look at it in principle, what's really happening is that you're converging the economic and the financial lens. That's all you're doing here, right? There are a lot of other aspects to it in terms of the technical aspects, but at a broad objective level, this is what you're doing. And that is what we do. The language that we speak inside is really the convergence of these two aspects. So that's the cultural part of it. In terms of to your second point,
customers, what's there for customers? Yeah.
On the customer side, I think clearly it's the three things that I mentioned. I mean, why are we relevant? We are relevant because customers are able to transfer risk to us. Now that risk is of 3 or 4 types. I mean, the risk of dying early, the risk of outliving your savings, and the risk of your investments not doing the way you expect them to do, whether it's on the equity side or on the interest rate or the debt side. Now, these are the three things that as an insurance company, we are able to do because of either the expertise that we have internally in terms of the people or the scale, or also the comfort that customers have, to kind of deal with us and, trust us with their with their either their savings or with their families if they are not there anymore. So these are things which clearly from a customer perspective, are they looking at our financial statements today while making decisions? No, but they're looking at our operating parameters. What are they looking at? Is this company doing well, reasonably well? Is this company paying my claims? Is this company selling appropriately? Are there any mis-selling complaints which are not being dealt with appropriately? Is the company giving me a good experience at the time of buying? Is the company giving me good experience after I bought the product and while the product is getting serviced? So these are the things that the customer look at today in any industry, including insurance. And these are the parameters they'll continue looking at going forward. Are we, is my disclosure in Form A or Form B or Form C, I think is going to be less relevant. Definitely what they will do is, as a secondary consumer of financial information, they will obviously try and make sense of what the investors are thinking or what the analysts are thinking or what the media is thinking in terms of how a particular company is doing. So they will continue to get their comfort from all of that as they do today. But ultimately they will look at, is there any sort of value that the company is bringing to them in terms of the offering? And I think they would continue to look at the operating parameters. That's
okay.
The way.
Thanks, Neeraj. Asha, tell us the same question.
Yeah, in terms of cultural change, of course, the collaboration is one of the things which is going to be very important. I would also think, at least during the implementation phase, a lot more skills of project management are required, which probably does not get so much of attention in the companies which are as business as usual. So you need, from a skill set point of view, you need somebody who will be able to understand a little bit of all the aspects which are involved with the implementation. So that's what I would think is important, at least during an implementation point of view. Otherwise, yes, I mean, as and when the more and more people read it, it's we have the fundamentals of it. It is just that we have to get aligned to what the new standard is and frame our thinking and get used to thinking in that way. Yes, a lot more in terms of lot more education is needed. I mean, one of my other panelists also alluded to this. It's not just the board; it's the senior management, and of course, the way we also start looking at results and the way, say, we do a business planning. Everything has to change. So in that way, we need to reskill ourselves. But I think we have the framework, the mindset. It's just that we have to put all of this together. And of course, I mean, temporarily we may have to look for people from outside who can take care of the business as usual aspects, and we move our people to actually do the implementation and understand the results. So from a consumer point of view, yes, I think if it is if the financials are much more widely understood, it will create a lot more trust in insurance companies. I think to that extent, if it because as any financial industry, I think trust is one of the most important things. So if this goes to improving trust, it should help us. There could be add-on benefits, like, in case if this is the balance sheet and on the capital requirement is also based on this balance sheet, like a risk-based capital, and it's based on this capital. And if there is some saving, the amount of capital that we need to invest may come down as compared to what we currently have. I mean, we don't know. Of course, it will depend on the individual risk profiles of the businesses, what the books are, what could be the ultimate regime. But if there is an opportunity for more efficient use of capital, then that benefit can be passed on to the customer. So maybe some of the products could become cheaper if that's one of the aspects which could happen from a customer point of view.
Okay, that should be music to the ears of the customers. Some of the products could be cheaper. Let's hear Subhrajit.
Yeah, I think
two aspects we spoke about the cultural change, reskilling people, or can it be done through alliances with others, etc., etc. And how does it affect, or is there any impact whatsoever as far as the customers are concerned?
Yeah, I think both Neeraj and Asha has covered it very nicely. I think one of the cultural changes is definitely collaboration. I think there is no doubt about that. And I am very glad to see also the two departments which are very operating independently, actuaries and finance. One saying managing the asset side, one managing the liability side, are coming closest. I think now both the department will have to work very closely. So this is a game changer for the way the insurance companies have been operating for a long period of time. And within their coming together, it will create a much more synergy and much more efficiency in the way the reporting happens, the overall deliverables of the organization as well. Beyond a certain level, I don't think it's a significant cultural changes as an organization as well, apart from these two departments and IT being the part of the PMO, part of the project management office. The skills of some of these cultural changes stemming from the change management, especially these two departments coming together, is going to be very interesting, and it will definitely help overall synergy for the organization. From the consumer point of view, I think very well put, Asha, that IFRS 17, the financial statement has to have come with the risk-based capital regime. And if the risk-based capital regime comes into vogue, this will definitely ensure the efficiency of the capital uses. And honestly speaking, that's it. Risk-based capital is all about using the risk in an appropriate fashion so that you can use the capital in most efficient fashion. As of now, today, we have to hold the capital for whatever risk we are taking. Irrespective of the risk we're taking, that there is a certain amount of capital have to be kept aside. Now, if you bring in efficiencies in managing the risk-based capital.
Yeah.
Product proposition and sharpening of the pricing. So that will create a lot of innovation potentially, potential innovations in the product I see with the risk-based capital regime more than the IFRS 17. I just expect the IFRS risk-based capital will be implemented with the IFRS 17, and that will be reflected in more and more innovations. Insurance product have seen some innovations over the last 4 or 5 years, both on the protection as well as covering the longevity risk, as well as covering the long-term guarantee risk. I think these innovations will continue with the risk-based capital regime coming into play. Yeah.
Okay, thanks. Let me bring Joshua in between. Every time I'm sort of, I'm probably unfair. I ask you to come at the end. So you come in the middle, Joshua. My question is this: you have been handholding quite a few companies in various markets, particularly in the APEC. Tell us, there will be many decisions need to be taken, and they need to be taken with a lot of thoughts going behind them, because some of the decisions once taken probably will be irreversible when it comes to implementation of this new regime. So can you throw some light on what are those kind of decisions which once taken, you can't actually reverse them, and they're very critical for the implementation of this IFRS 17. Joshua, over to you.
Yeah, thank you. That's a very good question. So how I would think of implementation projects, right? It's kind of like building a house. So when you build a house, you need to build your foundations, and then you build your level 1, 2, and 3, and so on and so forth. So how I would think it's that in a project, the foundations are like the calculation engine that you choose. What are the platforms you choose? So once you have chosen it, it's where everything sits on. So if you choose, if from the onset in your project plan, you think that, okay, I want it for pure compliance, which is more like, I just want to build a 1-story house, just something to shelter myself from, then you go for, you don't need such a strong foundation. But then once after that, after you build your first story and you decide that, maybe I want my second story, maybe I want a skyscraper. You cannot build those on a shaky foundation. You need something stronger. So that is one kind of, irreversible decisions that has to be made. And then other decisions that has to be made at, in a house, where do you set your pillars? The pillars have to be aligned. You cannot have, somebody put a pillar in one corner of the house, and then on level 2, another person decides that the pillar goes somewhere else. So things like this, in terms of pillars, we are looking at, your unit of account and IFRS 17. how do you define your offset relationship between a reinsurance and your normal direct contracts? So these are things which are very critical, and it needs to be aligned throughout your data management. It needs to be aligned through your calculations, your actuaries, and it needs to also be aligned with your final posting, how you're going to post that to your general ledger, so your current accounting systems. So they need to be aligned. These are decisions that must stick, and you make them upfront. And basically, this is where your cornerstones are. You don't change them, because if you try to change them, it's going to be very expensive. You need to tear down your whole building and start all over again. But then there are also other, when we build a house, there's also other things that you can change, like the wall paint, for example, like the color of the house. These are easily changeable. So for these kind of things, like how do you want to derive your coverage units? How do you want to do certain steps in your calculation process? As long as it's flexible enough, the solution that you're sitting on is flexible enough, you can always change them as and when. So these are things which, from the different implementation projects we've seen, and we try to, tell clients upfront that these are things that, can you please make a decision upfront? And these are things which are absolutely critical. And we can tell them, like, what are the implications of choosing A or B or C from the experience that we have. And then afterwards, play within the boundaries, or if you have other designs in mind, we can talk about it, and it might work. So these are experience that we bring from the various implementation projects.
Okay, thanks, Joshua. We need to hear Mandeep and Avdesh, but before that, Neeraj needs to go. So Neeraj, I'll ask you the last question, which I would ask others later, because you need to leave at 5:25. That's what you said, your investors call. Tell us, if I ask you to list the 3, 4, 5 the key challenges in terms of priority. Which are these challenges for this implementation of IFRS 17? Neeraj, before you leave.
Sure. Thanks, Tamal. And so clearly the 3 or 4 things, the first one would really be in terms of clarity at the local level, in terms of what is the kind of roadmap we're looking at in the context of the Indian regulations, like Mr. Sathe mentioned. That becomes absolutely the first port of call, getting clarity around that. Some segments of business, some condition precedents, if you like, in terms of risk-based capital. Worst case, both of these moving on a parallel track. I think that's the absolute least that we would really require if this has to, not become too onerous for external consumers of information as well as the teams implementing this internally. That is one. And of course, it has a business implication as well as in terms of holding capital on one regime versus, taking decisions on another, which is happening today in any case. Second is around some sort of clarity around the time frame. We've had this, for a lot of reasons beyond the control of the authorities making decisions. The timeline has not been very clear. Because we've not had clarity even at the standard boards, as well as the roles working internally at a local level, whether it's the accounting body or the actuarial body. A lot of these things also need to get sorted out in terms of otherwise a lot of the investment, both in terms of intellectual capital as well as resources, will not get the optimum outcome. So that is something that is important. I mean, it's better to say that we'll implement 6 years from now or 5 years from now, but that's it, right? And we will give you clarity in the next 1 year. You set up a roadmap for the next 3 years, do your dry run, and then you are on. So it's better to do that than to have a rolling kind of a time frame with a lot of questions unanswered. So I would kind of stop here, Tamal. These are 2 things.
Okay.
We got them out. The rest of the internal elements we can all figure out.
Thanks, Neeraj. I know you need to go, so you are welcome to leave. Stay safe. Let's get back to our old question. Mandeep, over to you.
I'll take a different take. There's nothing called IFRS culture, right?
Okay, please.
It's a burden or a gift, depend upon how we use it. So what we are doing is not granularizing the data. We are granularizing the computation. We are giving matrices which are earlier in, let's say, in actuarial and finance domain. Now this is in the balance sheet. Now, this culture that we're talking about is a culture of understanding a parameter, understanding its nuances, and taking action. Right? To me, producing a financial statement on set of rules, etc., is difficult but doable. But the cultural here is like how to use that, and because when you give people target, when you see the impact of action on a parameter which is getting reported outside, and this is how CFO behave actually. They see quarter on quarter movement in a parameter and say why this is moving, right? And that's why people start thinking why it is moving, what we can do to control it, right? Or manage it. And that's where the cultural element come into picture, that can you understand this, can you understand why it is happening, and so on, right? So that's the key element. I think skilling, it's not only the finance skilling. And I'll tell you one example. When we rolled out this program of sponsoring IFRS certification, we were thinking that only finance guy will do it. But risk team, for that matter, came forward, and there were 4-5 nominations from them. Actuarial team came forward. There was one or two, but they were in any case were involved in the full project. There was interest, and the people wanted to understand, and that's where I think it will lead to. When the problem become complex, more people jump into it, and that would be the mark of a progressive organization. The second question was, I think, whether the new product will come, what will be the impact on customer? Well, this element is not as much related to reporting, as much relating to the regulations, and specifically risk-based capital. There is another smaller piece of regulation which may cause trouble, is the expenses of management. So we have to think about how the expenses will be managed. Expenses of management regulation will work when the expenses are getting deferred, right? The allocation to a segment will change if the segmentation in IFRS is very different, or the IFRS demand the segmentation to be done the way the business is managed, not by the the 4-5 segment which has been mandated by IDA. So if those changes, the allocation of expenses changes, your capital requirement changes, the scene changes. So what will happen is that the basic nature of the product will not change, but which company pushes what kind of product or design what kind of product lines are more gaining attention to the company in terms of innovative products, etc. That may have some bearing in the short run. In the long run, everything get normalized.
Okay, thanks. Avdesh, the last word is yours.
Yes.
Question remains the same, but I just want to add one thing. This is for my personal understanding. Can you just little demystify of the work of an actuary? Because you have, we used to think about a decade back, or even earlier than that. Actuaries are somebody who comes from Mars. They are like in India. People used to say that there is only a half a dozen actuary or 1 dozen actuary kind of stuff and all. And I understand that actuaries will be playing an extremely critical role in this transformation. So if you can just throw some light on that.
Okay. Thanks, Tamal. Yes, I will try to elaborate on that point as well.
Even your designation, like that you are appointed actuary. So I needed to find out that what is the difference between appointed actuary and the head actuary, and I was told that it's the same. So there is always a bit of a mystery, and as I said, it's a very different kind of profession, and I don't know how many actuaries there at this point of time in India. Many parents want their children to be actuary because that's a market which is not saturated. That's what they say. So yeah, tell us a little bit, a few sentences on that also. Over to you, Avdesh.
Yes. So appointed actuary, if I would just elaborate on the first question that you raised, appointed actuary is a regulatory position that IRDA gives for every life insurance company. They work in parallel with the CFO, and they are actually responsible along with the CFO on the entire financial statements. So the insurance liabilities are something that are managed by actuaries, and CFO does the other side of the asset side and the expenses side. So both work together to draw out the financial statements and manage both assets and liabilities of a company. And I think the reason there are certain different skill sets required as an actuary, because we have to make certain long-term assumptions, because you're in the life insurance company, you're selling such long-term contracts extending to 50 years as well. And you have to make certain long-term assumptions around many parameters like mortality, lapses, interest rates. And that's where I think our training and our skill set gets to use. Obviously, we can't be right on every assumption, but the important thing to look at the data, important thing is to understand how the data is, how much credibility you can put on your data, and then you sort of project your assumptions on to calculate the liabilities, which is essentially the money that the company requires to hold to meet the future claims. And it becomes little critical coming into IFRS 17, and this leads to a question of having a skill set as well. So I think in IFRS 17, it is very important that there is a very good amalgamation of finance folks and the actuaries folks happen under IFRS 17. Currently under Indian GAAP, people have been, actuaries have been reporting the liabilities, and the finance folks have been, reporting the other parts of the financial statements. But there is a good collaboration that needs to happen this time. Finance folks needs to understand certain nuances of the actuaries. Actuaries also we need to understand certain nuances of the finances, and under IFRS 17, because the amount of change that is going to be massive for us, I think that skill set will need to develop over time for everyone, not just for finance, even for actuaries as well. And when I say skill set, it's not just the insurance companies. You have your auditors also. Now, because auditors will need to sign off on the financial statements, and there's under IFRS 17, there will be a lot of amount of cash flows and data that will come directly from the actuarial engines into the financial ledgers. So that would require probably auditors to hire actuaries as well in the companies for them to certify on the financial statements. So I think that scaling and the resource requirement will have to develop over time. Currently, it would feel a very massive change for us, because currently we have been doing Indian GAAP. We have not even moved for IFRS 4. Our solvencies are also actually in a formula based, not on a risk-based regime, whereas many countries globally in Europe and Asia, they've actually moved to risk-based regime. So the amount of change that is going to happen to India is going to be bigger relatively than what is happening to the other countries. And lastly, on the questions on the customer side, I feel fundamentally our insurance service, what service we are giving to the customer is not going to change. We give out, people save money with us in terms of long-term wealth, for mortality, for pensions, and etc. I think fundamentally those will not change even under IFRS 17. The secondary impact, what the panelist members said on the cost of capital, maybe the expenses would change. There are those secondary impact would come out in terms of pricing of the products might change, but fundamentally the things are not expected to change for the end customer.
Thanks, Avdesh. So we have already almost exhausted our time. So let's take a few more minutes. And last round, what I had already asked Neeraj, because he had to leave, we'll start with Asha. If I ask you to list the 3, 4, 5 key challenges in this transformation or migration or transition, whatever you call it. Unless you want to add anything about demystifying the role of actuary, you are allowed to do that also. But primarily, this round is on the challenges. Quick, 1 minute each.
Yeah, I think
Asha.
like Neeraj said, I think knowing the timelines will help. It's like an exam, correct? Like if I have it like 2 months later and I've just prepared, I might just pass. But if I have it 3 months later, then maybe I'll study and I'll get an 80 or a 90 or whatever. But if it is very far away in the future, maybe I will not be prepared at all, because it's something which is going to happen long time in the future. So to that extent, having a known date, I think would help us in preparing better. So that's one of the things. And also some of us, like we have to anyway prepare for our JV partners. So we might have challenges like 2 opening balance sheets, which we may have to reconcile in future. So, I mean, preferably, I think it's better if we know when the date is going to be, and whether the capital regime is also going to be consistent with an IFRS balance sheet. So that will help us also for planning of capital. Otherwise, all of us will have to, the current regime, all of us will need to plan for capital, and that will, I mean, it will increase the way the volumes are being written, the kind of products which you're writing. the capital requirement will keep on increasing. So we will keep on accumulating that kind of capital, which may not be required when we move to a risk-based regime. So knowing the date will help us. I think that's one of the things. And within IFRS 17 itself, there are lots of decisions which we need to do. So again, I think it's the question of how much to invest right now. And there could be some optimal decisions which we will have to take, like something like the decisions which we take will define future profitability, or it could define what is the net worth we start with. So what has to be optimized? So all of these decisions, there will be some iterations which you'll have to go through for us to arrive at an optimal decision. So again, like knowing timelines and how much to invest will help us get there better, I think. So these are some of the challenges which we should be.
Thanks, Asha. Let's hear Mandeep.
I think a fellow panelist has already talked about it. The first and foremost, and the most critical challenge is to get the regulation and the clarity there. I believe that whenever the roadmap opens, there could be a working group set up by ID or ICAI that will be needed to look at the other ancillary regulations. Once that is done, then it's a matter of time and investment. Whether you use a shortcut, a quick fix method of producing a report, or you go for a sustained reporting model, that would be the choices because the costs differ. Another thing would be the handling the transition period versus the steady state. The transition period here means that for probably 1 year or so you will be producing 2 sets of information again. Whether will you get the erstwhile financial statement audited or not, but submit to the IRDA. That could be the situation. And same with the solvency calculation, etc. That may keep happening, so it will increase the workload. But nevertheless, if this is a requirement for changing such large scale kind of a accounting change, and that may be helpful. The critical decision from our experience is the product classification basis which the accounting will get determined, as well as the investment classification. And this is where added nuance of what can happen on product side. IFRS 9 or Ind AS 109 will basically mandate what you can sell, what you cannot sell once you classify it in that manner. So that brings a real tough decision sometime in terms of how to deal with a situation where there's a loss happening, or decision is to sell a investment in interest of protecting in terms of protecting the policyholder's interest. So those are the things, but can be overcome. Once we'll cross the bridge when we reach there, but even before reaching the bridge, there's a lot to be done.
Okay, thanks. Abdesh, your turn.
Yes, so I think implementing any standard of this nature is always going to be challenging. It's going to be long and thought through process, but also it gives chance to the companies to take a fresh perspective. It also sort of gives you an opportunity to redesign your systems, your data flows, your legacy systems. So I think that is also an opportunity which company can use to transform the way they look at the business, the way they the systems and processes and so on. I think one of the key challenges, as I said, was around because the change is going to be big, the systems and the data side are going to be the key challenge. And I think Mandeep will like to always company will need to look at IFRS 9 and IFRS 17 in conjunction, because what IFRS 17 is trying to do on the liability side on a more market consistent way, on economic way, same principles are applying on IFRS 9 side also, where the asset side are going to be more on side on the economic value. So that both things needs to be looked at together. And I think having a roadmap, for example, let's say we're talking about 2025, and I think mobilizing the team very earlier on will help us prepare in advance. And I think that is the key one. I think because the time frame is, once the clarity on the time frame comes, I think quickly start out the project charters and make a project roadmap and start doing the implementation exercises will help us prepare everyone. I think mobilizing the team earlier on is going to be very, very key for us.
Thanks, Abdesh. So last speaker is in this. I mean, of course, Joshua is there, but before that, Subrajit.
Yeah, I think my fellow panelists have already touched upon some of the challenges. I think what I alluded earlier is that the timing. I think the timing is very important. Not from the timing it ensures that you don't invest ahead of the time, or not you are delayed for the project timeline. So My biggest worry is that the moment you invest ahead of the time, you have to go back and some of the things, as you rightly mentioned, are irreversible things to change. And they waste a lot of bandwidth and expenses. So given there is also the other part is that the optionality of the decision making in the entire process. And I always believe that this is a standard which gives the organization to think through before making a decision, whether it's a transition that you're going to make or some of the strategic choices you're going to make, and so on and so forth. So it's better to spend some time in thinking through this process and optimizing the output rather than jumping into it straight away without thinking. So that as long as we get certain clarity, so all we are looking for is certain clarity on how this information will flow to us. The earlier you get a clarity, the better will be the ability to plan on the road ahead. So
thanks, Subrajit. We have many questions. I'll only pick up 2 of them, but before that, Joshua, you need to tell us essentially what would be your suggestions, because you are interacting with other markets, global markets, where insurers are already adopting this IFRS 17 and Solvency 2 and the other norms and all. So what would be your suggestions? What are the key takeaways from your global experience? Your suggestions for the Indian entities. Joshua?
Yeah. Thank you for the question. So I think that that's what everybody mentioned, starting early, understanding the standards is very key. And also, everybody else is doing something. And there's a lot of learning opportunities from all the other markets. Like we are constantly learning, from, let's say, Canada, because they have a very active accounting body and an actuarial body there. So they are investing a lot of time into certain position papers. We have people in Hong Kong, we have people in Singapore, and even the European market, like IFRS, just released quite a lot of information. So I think that there are still some parts which are not as clear, and that's with any standard. But I think a majority of the portions are getting clearer by the day, and people are starting to learn, and people are starting to also evaluate the pros and cons. So that is definitely something that you're not building from scratch. You can stand on what other people have done. And then in terms of having it happen at the same time with solvency standards, we do see it happening in certain markets as well. Let's say even in Hong Kong, in Asia Pacific. And then there's also other countries which also have ICS 2.0, which is the International Capital Standard. So it's all happening at the same time. And what they're looking at when they look at a platform, they're looking at something, which can serve 2 purposes, kill 2 birds with 1 stone. So if, let's say, you have a platform that you can use for first IFRS 17, and then with some modifications, you can use it for another purpose, at least the return on investment is higher in this case. So that is definitely also something that people that are looking at and something that are learning from as well.
Thanks, Joshua. We have many questions which have been collected by my colleague Sachin Mampata, but I'm only for the time, because already we have exceeded time. I only pick up 2 questions, and both are for Mr. Sathe, because I don't think you guys will be interested to answer this, because one question is raised by you, and another meaning it's been, of course, repeated by somebody else and all. So, Mr. Sathe, are you with us? Mr. Sathe? It doesn't look like. Okay. So I don't know this one question already you raised. When do you think India will be embracing this? That's also your question you want to know. So I thought Sathe, being a former IRDA member, he would have thrown some light, which unfortunately is not there. The other question I thought, because lack of time, is this: what is the preparedness of public sector companies they're talking about? So it's very important because LIC is going for an IPO, etc., etc. So would anyone like to stick your neck out and talk on that? What do you think about your the preparedness of public sector companies? Anybody would like to throw any light? Anything from your friends, colleagues, peers you hear?
I would not like to say what is the level of preparedness, but I would think think that the challenges would be much more for them because it's like they have a lot more legacy data, legacy products, legacy systems, because they've been around for longer. So anybody who has been around for long, I think the challenges will be higher as compared to what probably all of us would have. So relatively I mean, 20 years is much smaller, say, as compared to the 70, 80 years that LIC has been around. To that extent, yes, the challenges will be higher for LIC.
Okay. Anybody wants to add anything? If it's not, unfortunately, Mr. Sathe committed that he would spend the time with us, but probably for some reason he need to step out. So thank you. Thanks, Asha, Neeraj, Avdesh, Subrajit, Mandeep, and Joshua. I think we have an interesting conversation on a highly technical subject. So the key takeaways are, the most important thing is this: it's not that the Indian insurance companies are not unaware of the challenges. You are aware of the challenges and you are preparing yourself in multiple ways. You spoke about the new skill set, you spoke about technology, you spoke about alliances, you spoke about the requirement of capital to meet the new risk-based regime, as well as the capital for implementing all these things. And also, but the most important, all of you say that you need a clear roadmap. So that, I think one of you is Asha, you said that if you know when your exam is 3 months away, then you can prepare right away from now and you can score higher instead of just being suddenly facing that tomorrow is your exam. So I think the ball is now in the court of IRDA. The regulator needs to give you a firm deadline. When is it going to happen? Obviously, it's not going to happen tomorrow or day after, not because of COVID, even in the general circumstances. But the most important part is this: Indian insurers are completely aware of the challenges and they are putting their house in order. So thank you, a lady and these 5 gentlemen, for your participation and making it interesting. I hope the audience also enjoyed. That's all from my side. Over to you, Manish. Stay safe and very good evening to all of you, and Joshua, for you, good night.
Thank you.
Thank you.
I was on mute there for a while. Many thanks to our keynote speaker, Mr. Sathe, and all our panelists. As Tamal said, IFRS is a very specific theme, but thank you for making the overall discussion interesting, even for someone like me who doesn't really understand the industry and its regulations. Thank you, SAS, for partnering with us. And thanks again, dear audience. Let me remind you, the last webinar for the series is next Tuesday, 11th May. Detail on your screen now. Same time, 4 p.m. We hope to see you there. That's all for us today. Please stay safe.